Lehman Brothers could have been saved, but someone chose not to save it. This was not an accident. This was never a market failure. A single decision made over one weekend destroyed the jobs, homes, and savings of millions of people. And the number of people who made that decision was far smaller than you think. On the morning of Monday, September 15th, 2008, the world woke up to unbelievable news. Lehman Brothers, the fourth largest investment bank in the United States, had filed for bankruptcy. A 158-year-old financial giant was erased from history in a very short time. It was the largest bankruptcy in American history. More than $600 billion in assets were crushed under $619 billion of debt. Markets collapsed instantly. The Dow Jones dropped hundreds of points. Credit markets froze. Banks stopped lending to one another. The problem was not money. The problem was that people lost trust. The collapse of Lehman Brothers did not only shake Wall Street, it pushed the entire global financial system to the brink. How did an institution that had survived World War II, the Great Depression, and countless crises collapse so rapidly? The answer was not found in 2008. It was rooted in what had happened to modern finance decades earlier. Lehman Brothers was founded in 1850 by three German Jewish immigrant brothers, Henry, Emanuel, and Mayer Lehman. At the beginning, it was a small cotton trading business. Over time, it expanded into railroads, industrial investments, and financial intermediation. For more than a century, Lehman managed to adapt to changing conditions. It survived wars. It overcame crises. By the mid-20th century, Lehman Brothers had become one of Wall Street's most respected and established investment banks. But the financial world was changing, and Lehman had to change with it. The 1980s and 1990s were the years when financial deregulation accelerated. Rules were loosened. Those who took risks earned more. Short-term profits began to outweigh long-term stability. It was during this period that Lehman Brothers moved away from traditional conservative banking. It focused on aggressive growth strategies. Pressure for returns increased. Risk became invisible within the balance sheet. By the early 2000s, Lehman's primary focus was mortgage-backed securities. From a distance, the system looked simple. Hundreds of home loans were bundled together, split into different risk tranches, and sold to investors as safe products. On paper, risk was evenly distributed. In reality, it was hidden from people. This entire structure was built on a single assumption: housing prices across the United States would never fall. Lehman did not want to question this assumption. On the contrary, it made it the core of its business model. By 2007, Lehman Brothers' balance sheet had exceeded $600 billion, but its actual capital was only $22 billion. This meant leverage of 30-to-1. At that level, even a small decline in asset values could wipe out the bank's entire capital. When housing sales slowed, the mathematics of the financial system reversed. Mortgage defaults increased. Mortgage-backed securities rapidly lost value. Anxiety spread through the markets. Expert analysts warned Lehman and its management. But CEO Richard Dick Fuld ignored these warnings, believing the situation was temporary. That same year, Bear Stearns had collapsed, but Lehman believed it was different. It believed it was too big to fail. But financial markets do not run on belief. They run on liquidity. Lehman's real problem was not bankruptcy itself, but being funded by others. Modern investment banks had to borrow short-term every single day. Repo markets, overnight loans, endless rolling debt. In 2008, these funding sources began to disappear one by one. Counterparties started losing faith in Lehman's balance sheet. Trust collapsed. And when trust disappears in finance, there is no option left but collapse. In September 2008, emergency talks began. Potential buyers sat at the table. The market expected government intervention. The U.S. government had already rescued Bear Stearns, Fannie Mae, and Freddie Mac. Lehman expected the same treatment. But this time, political pressure changed everything. Public opinion was firmly against another bailout. Treasury Secretary Henry Paulson refused to provide a federal guarantee for Lehman. Without government backing, no bank was willing to absorb Lehman's risks. At 1:45 a.m. on September 15, 2008, Lehman Brothers was forced to officially file for bankruptcy. The effects were immediate and global. Banks halted interbank lending. Money market funds collapsed. Trillions of dollars in short-term financing vanished overnight. Banks in Europe and Asia faced severe liquidity shortages. What began as a housing crisis in the United States turned into a global financial catastrophe. Lehman's collapse was not the cause of the crisis, but it exposed just how fragile the financial system truly was. In the weeks that followed, governments were forced to step back. AIG was rescued. Bank capital was increased. Central banks created and injected trillions of dollars into the markets. The financial system was kept alive. But the public paid the price. Millions of people lost their jobs and their homes. Losses created in the private sector were transferred onto the public. Lehman Brothers became the symbol of a ruthless system where profits are privatized and losses are socialized. Lehman did not fail because of an isolated mistake. It failed because it behaved exactly as the system rewarded it to behave. Understanding Lehman Brothers is not about looking at the past. It is about understanding how today's financial system operates like a machine. Every bailout plants the seeds of the next crisis. Every solution writes the story of a future collapse. And that is the real reason why Lehman Brothers still matters today.